not just from a asset point of view, but something different for the investors, something that they can be proud of, something that we can be proud of, and ultimately our kids will look up to us for.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody. So we've got a great episode today. I was actually on site in Dallas with New Haven Marinas, and formerly known as Windlass Marinas, and we made an investment in their prior fund. I call it a fund, but it was really a 2-property syndication. We were actually able to come in after they'd already purchased the 2 marinas that also had an RV park component to it, and actually a few houseboats that can rent, as short-term rentals. So we tried to get the 3-camera setup going, and we had some technical issues. So this episode is primarily the cameras focused on them. We did use my wireless mics, and I'm essentially behind. We're recording on my laptop. So hopefully the sound quality is good and you could hear me, and more importantly hear them talk about their story and some of the amazing benefits of investing in RV park marinas. We're really bullish on the space. I've done a fair amount of diligence, and our current investment's going really well, and we're working on some custom opportunities with them. The benefit of how JCAM operates is we'll negotiate special terms for our funds and for our investors. So we're still finalizing opportunities for the new fund, and they're actually working on a new private placement currently. But we're going to have an opportunity to either come in through our diversified fund or through our direct deal platform, where we'll have a special deal for investors. So hope you enjoy this episode. I thought it was a ton of great information, and we will keep this content coming. So just remember to subscribe to our YouTube channel, follow us on iTunes, Spotify, leave a review if you like what you're hearing, and connect with us on all of our social media. We have JCAM Investments across the various social media, and we have a Facebook group which is growing. So the Alternative Investor Mastermind Facebook group, going to have some exclusive content up there, and building a nice community to discuss various alternative investment opportunities. So if you're a Facebook user, please check that out, and hope you enjoy this episode. All right, everyone, you can't see me at the moment, but I am in the office of New Haven Marinas, formerly known as Windlass Marinas, and JCAM Investments has been an investor in their prior fund. And today we're going to talk about the value of investing in marinas, and to some extent RV parks as well, and really excited to have this conversation with you guys. So I've got Matt Layton and Josh Conley from New Haven Marinas here today. How you guys doing?
Great.
I'm doing good.
Thank you for having us.
After last night's soiree, but
I bet. Yeah, we had a great event last night. Had 50, 60?
60 in person and another 24 online. Yeah. So
That's great. So this is a relatively new niche to most investors. Tell us a little bit about your backgrounds and how you found and how you started investing in marinas.
I come from the oil and gas world. We raise private investment funds from retail investors for projects all over the United States. And my business partner there is Dallas Hayden, who is a owner and founder in Windlass Marinas and Matt's partner. And after talking about the marina world and learning more about it, I reached out to Matt and decided that this was an area that I'd really felt I could contribute from an investor relations standpoint and ultimately from an operational standpoint in helping the company grow.
Yeah. My background is multifamily, business acquisition. Worked for a prior firm with Dallas, my other business partner, and we really just wanted to find out what the next big thing is, right? Everybody's always looking for the next thing, and we've seen it just across the board in multiple industries from basically the early 90s to today. Everything is getting consolidated, and so we wanted to be on the leading edge. If you go back and look at 2008, 2009, the only reason why I bring that up is because that's probably the largest consolidation of real estate for the individual investor that we've seen in the past 30 years, and that was multifamily. And so if you could have been on the leading edge in multifamily back then, you would have made a wonderful ROI. And that's really what we're trying to accomplish. We always want the investor to win, and we just look for the next best thing, and it happened to be marinas. And they just offer a wonderful mix of revenue generators and different aspects that really just bring a culture and community together. That is something that we're all very excited about.
I don't think there's a question in life, anything you do in business or investments, if you're ever afforded the opportunity to be the first in, to be a market breaker or a pioneer in an industry, you're going to reap the biggest reward. Oftentimes, retail investors, and when I say retail investors, typically that's an investor that has under a $20 million net worth. You haven't had access to being at the front of a wave. You look back at multifamily, it was predominantly controlled by private equity and institutional banks. And most commercial real estate, that has followed the same pathway. And marinas is one of the very rare opportunities where we are affording the access and the ability for investors like you to join the wave and be a part of the momentum that sets the tone for the next 10 years as this consolidation ramps up.
Yeah, and I'd say what's great about it is, although as Josh mentioned, that the beginning stages typically are controlled, by the BlackRocks and the KKRs and some of the larger, private equity firms. And it's always the retail investors that come late to the game. That has started in the marina industry. So there are other pioneers in this industry that have already proven the model on a small scale. You look at Safe Harbor. They started in 2015. They acquired 100 more marinas from 2015 to 2020, middle of 2020. Did a majority recapitalization or sold 90% of their equity to Sun Communities, which is traded on the New York Stock Exchange for $2.1 billion. So they've proven the model. They've retained the private equity. They continue to grow, but they don't want to do it at the level we're doing it. We're willing to go out and do the grunt work by 1, 2 at a time, provide an opportunity for the retail investor to then be bought out at some point by the larger capital sources.
And I think it's important when we say there's already competitors in the marketplace, there are 2 very large consolidators, and there's probably 5 consolidators overall that have a name in our industry. None, again, offer the retail investor access in an equity position in the ownership group like we do. But even though they're there, competition's always great. There's 10,000 marinas roughly in the United States. There's maybe 2% to 3% control by the 5 biggest consolidators in our market. So while they do have a presence, we still have 95% of the market that we are able to go and share in, and that's where we see the opportunity, and that's where we also see the competitive advantage.
That's a great time to ask about sort of how you add value. Many of our listeners may be familiar with the multifamily value add, renovating apartments, self-storage value add, adding climate control. When you take over Marina, what do you look for? How do you add value?
Yeah, there's so many.
There are, yeah, and again, it boils down to each individual revenue source. You do have to do, case studies on each component in a marina. Typically, when we're looking to buy a marina, we want a minimum of 4 revenue streams. Each one of those revenue streams will have multiple different revenue streams in and of themselves, depending on the product mix that they're providing, right? The biggest value that we provide to a marina is really capital. You look at any mom and pop business, their biggest point of contention is that they are satisfied with their earnings. They don't want to put more money into it. They're happy. They don't want to take the risk associated with going and getting a loan or reducing their compensation that year to be able to add more value. They're in this industry, a lot of them have been in it since the 80s, so they're a little older. They don't want to go out and learn a new technology. They don't want to add those things to the business to bring value. So
they also don't see the return. There's not a corporate level infrastructure where you have a management team that can show the pros and the cons of doing XYZ to the business and then ultimately show how that would net down to their returns. They don't have that. And really, it's capital and it's efficiencies. Marinas, by and large, are technologically inefficient. And we see that up front when we do our due diligence and we analyze their numbers. We get into the financials and the accounting, and it's a mess. They don't have enterprise software that controls every aspect of their business. By and large, they literally keep financials on Post-it notes, notebook paper, and they stack it on top of desks. And it creates an opportunity for us to come in and introduce those efficiencies, create more of a corporate structure from a management to the operations of the marina. But I want to call something out. We are a marina acquisition company, but I think most investors come from the commercial real estate world, whether it's multifamily, storage and warehousing. Potentially they're in commercial real estate with like strip malls. It's very different from that because you have typically one primary revenue center, and that's your rent. When you think marina, you need to think resort. When you think of a resort, you think of the all-inclusives in Cancun or in Cabo, or you think of the big hotel infrastructures in Florida or in California. We're more closely related to that type of business model than we are the traditional commercial real estate. We do have the long-term rent component from our wet slips where they keep the boats on the water, the dry storage where the boats come out of the water but still have a storage facility, and then we've got campgrounds typically that are annual basis. So those are our long-term rent components that you're familiar with, that you can easily compare to the world you've become known or accustomed to, whether it's multifamily, storage, warehousing, and so on. We also have restaurants. We have a marina shop. Think gift store combined with a convenience store combined with a gas station, because we do have a gas dock. We have a repair and maintenance facility at most marinas that do work on the boats, get them ready for the season, and do boat repairs. We have the ability to have a boat club, aquatic rentals, short-term cabin rentals. There is a large complexity of revenue centers that add to the bottom line in addition to that long-term rent component. But that altogether creates a operational and a management challenge that most family-owned businesses don't have sophisticated softwares and systems in place to manage that efficiently and increase economies of scale, reduce cost of goods, and increase the bottom line. That's where we come in with our team. We realize the opportunity. We go in, we initiate our changes, and our last acquisition in Tennessee is evidence of that. 6 months into this year, and we are 26% above cash-on-cash profit from where they were last year. And we've done that with less than $150,000 in capital infusion to the property. So, those are the types of things we look to bring to the table as we acquire more and more properties.
Let's talk a little bit about demographics. There's obviously a lot of baby boomers are reaching retirement age, and talk about why you think now is the time to really go big in the marina investment space.
Yeah, so I think one of the greatest opportunities that exists right now is you do have a lot of baby boomers that are getting out of whatever full-time business or job or whatever it is that they have, right? They want to spend more time doing their leisure activities. those people have typically always owned a boat. They just haven't used as much. So we'll see an increase and an uptick in revenues probably from those individuals spending more time at the property,
using those resources, the restaurant, the gas dock, the marina shop,
which is a wonderful thing to have. But ultimately, we want more stabilized revenue in anything that we look at, right? So your ultimate goal is to be able to expand and grow and increase rents on your wet slips and your RV sites and things like that. One of the greatest things that we've seen over the last couple of years is we have 800,000 first-time boat owners that are entering the market. That's created a logjam at every marina that's worth their weight. You go to any lake, you try to get a boat slip, they're full. And they have 100 to 200 person waiting list at every marina that I've visited over the last 2 years.
Yeah, it starts at the boat stores. I mean, you call and you try to get a boat. It's very, very similar to the automobile crisis we've had since COVID. They can't make these RVs, these boats, these cars fast enough to satisfy the demand that currently is here. And that's not just because they can't build them fast enough. There was a technological issue with sensors and with chips that I'm sure most people know that affected everything from microwaves to semi-trucks. That created a logjam. 800,000 new first-time boat owners has created a logjam, not just at the purchasing point for the boat itself, but for the place to put the boat.
Right.
So we're definitely capitalizing on that with what we're doing.
Yeah, and I would say on top of that, again, like I mentioned, most of these baby boomers have owned boats. Those kids that are now Gen X and millennials grew up as young kids going out on the boat on the weekend. But they've lost that over the past 10, 15 years when they had to go out and get jobs and they're building their own families. And what's happened since COVID is those individuals have now rediscovered and had a euphoric moment where they're like, man, I had the best times on the lake with my family, my cousins, family reunions, doing all that kind of stuff. So they've gone out and bought boats. Now they're bringing their kids out. They're rediscovering those wonderful memories that they've had and are introducing their kids, which will continue the growth in the boating industry.
In the 80s, it was sailing with your dad. I think most people can visually and remember a time where sailboats really dominated the waterways. Now, if you're on Instagram or social media or YouTube, or you're watching the active channels like Discovery or Speed, whatever it might be, it's transitioned from the sailboats to the power boats. Everybody wants to wake surf behind the wakeboarding boats, where if you're not familiar, the boat creates a massive wake behind from the propeller, and you literally jump out on a surfboard and you have no string attached to you. It's just you, a life jacket, and a board, and you're surfing behind a boat. That's dominated the recreational aquatic space even more so than skiing or slalom skiing or kneeboarding or wakeboarding. It's now wake surfing. And so that transition has really driven the powerboat industry, and it's really reinvigorated the lake life community. The wakeboarding, and then you have the pontoon side, where a lot of families also want the leisure aspect of going to a marina. They want to be able to take out their family and their friends, have a deck platform where they can move around freely, cruise around the lake, maybe pull people behind them in a big raft or a tube, and just have family-oriented fun. And that's certainly when you go to marinas, if there is an occupancy issue, it's not because there's not a demand, but it's because a lot of marinas still have 30 to 50% of the marina dedicated to sailboats, and there's just not those sailboats anymore. Right. When you ask about opportunity and value add, that's the next component. We can go in, take the existing structure, and cover it. The minute you cover it, you bring in electric, you bring in water, you bring in other utilities, including Wi-Fi, and now you've created an environment where somebody with a powerboat or a pontoon will take advantage of that open slip, come in, move in their boat, build a deck in front of their boat. It's truly a lifestyle. There are people that have boats and then a 400 square foot deck with a bar and a TV, and their friends go out, and before and after they're on the water, they're hanging out watching their favorite football team on TV on a Sunday right next to their boat on the dock. So covering boat slips is a huge advantage and an opportunity with capital infusion. to increase occupancy if there's an occupancy deficiency, and then increase revenue. With a covered boat slip, with introducing Wi-Fi and other utilities that may have not existed before, you're able to increase rents and take advantage of a market right now that is currently hungry for a place to park their boat.
Yeah.
And let's talk a little bit about numbers. What's multifamily? Obviously, cap rates are 4-5% in most cases now. What are we looking at when we're looking at the marinas?
Yeah, so really we try to go in any negotiation at a 10 plus. Our last acquisition ultimately ended up at about 11.5 entry cap rate, and that really affords us the opportunity to continue to learn and grow in the space. If you look at buying a multifamily right now, either you're over raising, or if you raise the right amount, any sort of hiccup, whether you have an issue with mold or whatever, could drastically change that opportunity for the investors. It even puts them at a greater risk. Whereas again, we have a little bit more flexibility in saying, oh, you know what, we need to pull out these slips because we have to replace all the flotation. They're going to be down for about 6 months. Right now, we could lose 40% of our occupancy, still be able to hit all of our debt service, pay all of our people, and hit our investor preferred return. So that's what happens when you buy at these high cap rates. You're afforded flexibility to be able to take something out of service for a while, to be able to repair and make it better over time.
The higher the cap rate, the more margin and the better ability we're going to have to meet the demand for our investors and to meet higher return, higher IRR expectations. Most deals you're going to see in any other commercial real estate class right now is going to have a pref. It's going to show you a projected IRR around 18 to 22%. But most times you're going to see you won't make any money in the first 1 to 3 years because they need that time to go in, make improvements, upgrade facilities, increase rents before they're going to have enough coverage to be able to not only cover their debt service, but also be able to pay investors a return or a pref. With us, we're able pretty much on day one to enter to the operation and meet a 8 to a 10 pref structure. But I want to take a step back. Cap rates is a technical term that a lot of people use in the finance and in the alternative investment space. It is a great way to see on paper, just high level, what kind of deal are you getting. Higher the cap rate, the better the deal. If all things are equal on the purchase or on the operational income, your cap rate's going to define whether you're getting $1 million revenues for $10 million or $1 million revenues for $20 million. Obviously, if you can get it for $10 million, you're getting a better deal. But if you're not familiar, I want to really try to make it simpler. Think about residential flipping. I think everybody has either flipped a home, has looked at doing some type of residential rental real estate, or they know somebody that's been in the flipping business. What we are doing is we are finding a home in a neighborhood where the average neighborhood, the home is worth $250,000. We're going in and we're able to buy that home for $50,000 to $100,000. We go in, we put in the new carpet and the new countertops and the new fixtures, and we paint the walls, and then we put it back on the market. What we just did was took advantage of inefficiencies or a lack of improvements and got a great deal on a property. When we go and sell that property, the next person is going to have a lot less margin to go in and make improvements to increase the house that much more in value. The first person in any industry, anything in real estate, is going to have the largest margin of opportunity to increase the net monthly rent income and ultimately increase the overall value of that property. It's no different in marinas. We have a lot of different arms out there where it comes to revenue centers and where we're going to generate income. But ultimately, we're going in, getting a property that we know as a Class C or Class B, we could put the right money, the right resources, the right operational and management structure in place to increase it up to that Class A style marina property, which will ultimately, for you as an investor, when we sell, make you the most money.
That's great. And you mentioned earlier that there are larger funds that are aware of the space, but You mentioned to me about they're not going to take the time to you're not going to have a Wall Street guy dealing with an owner who's got the boat slips on Post-it notes with the owner's name on it.
It's a grind.
Yeah.
It's
a headache.
They look at this space and they see the light bulb. Anyone with a financial background can see the cash flows that marinas provide, see the margins and the opportunity that family-owned enterprises afford corporations, private equity, institutional money. But the minute they start looking at a deal and they see the cobwebs that the finance and the accounting that really hasn't existed present, they see the cobwebs of, oh my gosh, I got to go in and in the next 5 years, I have to take the foam that's underneath the docks that allows it to float in the water because of federal and state regulation changes. I'll have to go in, take all of that foam out, bring in what's called encapsulated, just think a big plastic structure that goes underneath that dock to allow it to float. It's things like that they see, they don't have any experience in, they don't want to deal with that headache. Mm-hmm. They want to come in and they want turnkey. They don't want to flip that house. They want you to go in and flip that house and do the grunt work for 6 months and the blood and the sweat and the tears involved in the process. They want to come in and buy that house from you, and then they just want to capitalize on the improved rents. They'll pay a premium because they're going to get that premium rent. They don't care about the improved margins. They see that as the opportunity for us. What they want is somebody to go in and do that work for them. Yeah. And ideally, that takes time. It takes a lot of hard work, a lot of grinding, a lot of those blood, sweat, and tears. And they want to capitalize on someone that's willing to do that.
I can't tell you how many times I've walked into a marina office, talked to the owner, asked for a layout of the property, and he rolls out a piece of butcher paper, and it has everybody's name on a slip and a little graph that he's drawn, and he writes on there a little check every month for the year, whether they're current or not. I mean, those are the types of things that we deal with, but that's what makes these properties worth it. That's why we're paying a 10 to a 12 cap rate, because those inefficiencies are there. And we have to go in and dive in. We have to take out, the $1 million a year that they're paying themselves, or if they've gone out and built themselves a new barn and put it on the expenses of the marina, you've got to take those types of things out of there to get to the bottom NOI. And so that's why we're afforded and able to buy these things.
The most important process in any asset acquisition, it's due diligence. Having the right people in place that understand the underwriting and due diligence process to do what we call forensic accounting. When you go in there, for example, and you see that a property has 3 locations, but only 1 location is buried in the burden of the insurance for all the properties, that's something you have to go in and reallocate. When you see that the owners paid $1 million in salaries and you find out each person that was in that $1 million was a grandson, you have to factor, is that a salary that you're going to carry as a burden moving forward? It hurts their bottom line when they show their profitability, but for us, it's an inefficiency that we can go in on day one with very little dollars spent. Really, it's just a stroke of a pen, and eliminate a lot of those inefficiencies on day one. Our most recent acquisition, we increased rents for our wet slips and our campground 20% across the board, and we lost 0 renters. We did that by doing a simple market analysis, seeing what our competitors that were a similar class structure as us and then the class structure above us, what they were charging, realized we were very behind. We're still behind. And so we're going to have multiple years of significant rental increases to get us up to par with the rest of the market at that lake. That didn't cost anything. It was something we're able to implement on day one, and we increased the bottom line by 20%.
Yeah, I've heard that across a number of industries. Small town self-storage where the owner plays golf with half the people using the storage facility, and he's afraid to raise rents because he doesn't want to take a bunch of crap from his buddies on the golf course.
Yeah, and a lot of these guys, again, they're satisfied with the income that they're earning. They don't want to ruffle the feathers of anyone that's there, because everybody that potentially leaves, it affects their income, right? But what they're not understanding right now is that because there's such a large wait list, you immediately fill those spaces right back up. And ultimately, those people aren't going to leave if they can't get their boat in the water somewhere else. They're going to deal with it. And any industry that you go into, I talked about this last night. A good friend of mine owns a Chick-fil-A. You have the 10% jerk factor. You're going to have people that are upset no matter whether you never raise rents or whether you provide them free Wi-Fi. They're just going to be upset. And you got to get through that. And a lot of these mom and pop owners, they just don't want to deal with that.
I think everybody has that neighbor in their neighborhood that's never happy.
That's right. Yeah, you always see that person in line at Chick-fil-A or the drive-thru that just complains.
No matter what happens,
And
they're not happy.
again, it's part of life. It's part of being a grown-up. You deal with it. A lot of these people, again, they've just gotten satisfied and don't want to do the work or take the effort to have those conversations.
Two of our core values are loyalty and family. I think those two really are the foundation behind any person's legacy, person, family, or business's legacy. Matt mentioned most marina owners have been in the business and the operational or the ownership of the marina that they're at for over 20 to 40 years. Family, loyalty, legacy is important to them. And there is a difference between loyalty and charity.
Yeah.
When you are 80% behind market rents, you are giving a charity and you're not operating a business that benefits you. And if they are loyal and they are a part of the family as a renter, they know as you increase rents, you're doing it as long as you're doing it in an incremental amount and it's fair, that what you are doing is fair. And ultimately, if they're not happy, then they can seek out somewhere else to go. Because at the end of the day, we are going to be running a business. But
right.
The competitive advantage we bring to the table, we've already in a short amount of time built a reputation in this industry as a company that really tries to honor the legacy that the owners have created and built and fostered in their 20 to 40 years of ownership. And I think that's become a big deal because the two largest consolidators in our industry, they don't care about legacy. They don't care about family. They don't care about the personal relationships that the owners have with every single renter that's there. They've seen these renters' kids from when they were born to now they're buying their own boats for their own slip. We're going to do our best to honor the legacy and the image that they have built, while also bringing in a little bit of a heavier hand from a business standpoint. But it's something that we consider to be very important to us, and it's why it's a part of our core values.
And to Josh's point, nothing against those larger consolidators. They're now run by hedge funds that's just the way they operate. But that's what we love about working with the retail investor. Retail investors typically share the same thought patterns that we do. We may not share everything, but legacy is important to the retail investor too. And we find a lot of times that people can associate with our core values and want to work with us because we're doing some of the same things that they would do if they were running the business.
Great. And tell me about some of the new opportunities that you're diligencing right now.
I'm going to let you take the one on Norris Lake of Tennessee.
Yeah. So obviously I'm not going to throw out any specific names right now just because we're still in the process of getting it under PSA. But we do have a significant opportunity on the same lake where we already own the first two marinas, which will provide us more efficiencies as far as management and sharing and costs and technologies and things like that to be able to implement across 3 different marinas. I mean, ultimately there's probably 3 or 4 more on that same lake that we can acquire over the next couple of years. So we're really looking forward to just maximizing every efficiency on that lake. But ultimately we'll be able to buy this new property, which is over 500 on-water storage with a mix of RVs. It's got condos that have their own wet slips that we manage and take care of, and they pay us to do that. We've got gas dock, we've got restaurant, we've got ship store. And so we're really looking forward to adding that to our portfolio there. We'll be able to buy it at again, probably around 11 cap rate. And one of the best things about it right now is we should be able to assume a 4.5% interest rate on 60% of the acquisition price over the next 5 years.
Yeah, we've got a banking crisis, I think, on the horizon. And Warren Buffett has famously said when there is a depression or there is a decline in a market, then there is an opportunity. And the people that are in the position to take advantage of that opportunity when it comes are going to become the most successful when we come out of whatever that tumultuous time presented. And right now with banks, we are seeing significant regression in loan terms, willingness to do loans. Rates have skyrocketed. Everyone's aware. We were at 4% a year and a half ago, and now most rates are 7 to 9%. So that opportunity presents an incredible advantage to assume a note that's in the 4% range. And then there's another marina property north of the DFW Metroplex we're excited about. It's on a very large lake that's very popular in North Texas. It also provides the advantage where we can share in the owner's note and come in at around a 4% rate as well. Those are the type of things that we are being very cognizant of during these higher interest rate times. And it is an advantage because it'll allow us to have 2 to 4 years at both properties to wait for the interest rates to come down a little bit. But that marina property will bring 600 wet slips to the portfolio if we can make that acquisition. It also provides significant other revenue centers, including gas stock, a very reputable restaurant, and it has one of the larger revenue performing ratio centers at properties we've looked at with their marina repair shop. So it's not something you're going to have at every marina, certainly not to the magnitude that this one presents, but this marina has a great reputation for boat repair, boat maintenance, and it's something that we would hope to continue at least where it's at and potentially expand if the correct opportunity arises after we take it over. The other thing there is, by and large, 60% of this marina was dedicated to sailboats for the last 30 years. They have a waiting list of over 150 power boats right now that need a covered slip. So that's something on day one we would build into the acquisition price, the ability to bring about $1 million in CapEx to immediately cover 30% or 50% of the uncovered slips, to have the ability by day one of the busy season next year, have those rented out or at least assigned to a boat moving into the 2024 busy season.
Amazing amount of information you guys have covered here. Do you have any parting thoughts, any tips for investors that may be interested?
You know, I come from the oil and gas world, and I came to the marina world because it is fresh, it's exciting, it's new. We really are a part of the group of pioneers that are bringing this wave of consolidation in a space that, by and large, no one's looking at right now. If there's a promise that I can make 10 years from now, you're going to talk to somebody and they're going to say, wow, I didn't know marinas would have been an investment I should have considered. Boy, what I wish I could have gotten in 10 years ago when it was just starting. Marinas are a fun place to have a life and a community and an escape from your everyday. Take advantage and be a part of the investment that facilitates that community and that lifestyle to over 140 million Americans every year that go boating. We are a part of that community now. We're excited. If you're not looking at this investment, reach out. Let us educate you on what we believe, why we're excited. I think this is something that, whether you're ready today or you're not, the more you can learn, the more education you can have in any investment, the better situated you're going to be when the cash flow, the liquidity, or the right opportunity in your life approaches. And when you're ready, you're able to make the decision that best fits you, it fits your family, and it fits your future.
That's right. Yeah, I mean, as far as advice is concerned, just work with the people that you trust for now. There's a lot of uneasiness in the marketplace. There's a lot of newcomers to the industry that have found that they can make a quick buck, and typically they're taking it out on the front end. Just make sure you're using somebody you trust. Work with those that you know. Work with those that people know and have a good reputation. Don't get shiny eye syndrome. Make sure you do your research. And that's what we tell everybody that works with us. I'm not interested in just the capital that you can provide. I'm interested in making sure that you're educated and you're protected. And then ultimately you build your own financial legacy out of all this. I think Josh and I can both attest that we've come from other firms and industries where that hasn't necessarily always been the case, and that's why we left. We wanted to do something different, and not just from a asset point of view, but something different for the investors. Something that they can be proud of, something that we can be proud of, and ultimately our kids will look up to us for.
Great stuff. Well, guys, thank you so much for coming on and providing all this great information. And our fund is personally invested in your prior deals, and we're going to be very active, in your upcoming offerings when they're ready. And look forward to chatting again soon.
Well, thank you for having us. We're really excited about how this partnership's going to grow in the coming years, and look forward to getting to know you and your investors better. And again, we're a very open company. Anytime anyone has any questions, route it through Jack or call us directly. We're always happy to, educate.
All right. Well, guys, thank you very much.
Thank you.
Thank you.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.